Hey everybody, in this video we're going to be talking about the basics of monetary and fiscal policy. And the first thing to understand about monetary and fiscal policy is they are macroeconomic policies. And so to understand monetary and fiscal policy, we're going to need to talk about the macroeconomy. We're going to need to understand the goals of the macroeconomy, and then we can understand how monetary and fiscal policy fit into those goals. So let's get to it. The first thing I want you to see is I've got a graph, the business cycle. This graph right here, I like to call it the foundational graph of macroeconomics. I'm not saying it's the most important graph in macroeconomics. I like to say it's the foundational graph. It's why macroeconomics as a discipline exists. Not why economics exists, but why the study of the macroeconomy, the economy as a whole exists, is because of this graph. Because market-based economies tend to grow in this boom, bust pattern. Now understand, every developed country in the world kind of tilts towards market-based economies. If you tilt too much towards socialism, we generally think we're going to affect incentives too much, okay? That we're going to have negative impacts on incentives. So we want to have enough incentives in our economy. So again, developed countries tilt towards markets. And when you have a market-based economy, this is what you get, is this boom-bust pattern, or at least history has shown we generally go through some patterns of booms and bust. And we do not want to grow like this. We don't want to have peaks and then recessions and then troughs and then recoveries and then peaks and then recessions and troughs. We don't want that. Why? Because these recessions, these contractions, those times of bust, guys, are incredibly painful for people out there, okay? And not only that, the boom times can be times of inflation and the problems of inflation, okay? And the bigger the boom oftentimes leads to the bigger the bust, okay? So we don't want to grow like this. We want to moderate the business cycle. That's right. There it is. Macroeconomics as a discipline exists because we want to understand this cycle. We want to understand why it exists. And then we want to understand, is there anything that we can do to moderate it? Okay. Now, some of the things I'm going to say, certainly people will have exceptions with, because I'm going with the consensus view of macroeconomics, okay? And certainly we've got people on all sides of the political spectrum who are going to have their own takes on things, and you know what? They might be right in the end, but I'm just trying to show you what the consensus view is today, all right? So, the boom and bust pattern, generally because of our market-based economy. Certainly governments sometimes, if they have bad policies, might also create some of this instability. But generally we're going to look to government and the central bank to try to moderate this. Again, certainly people will argue that it's governments and central banks that actually can cause this to even be worse than it would be without their intervention. But the consensus view is they can come in, intervene to moderate that. So let's get into why do we get into these patterns, okay? Why do we get into prolonged periods of contraction and prolonged periods of recovery? And for that, I want you to look over here, okay? The boom and bust cycles, okay? So here's the thing. We don't know exactly what might cause this turn right here, okay? It could be a lot of different things. I'm gonna call it just shocks out there. So some negative shocks. A lot of times it might take more than one shock. You get these negative shocks, and what happens is consumer and business confidence start to turn down, right? So here we go. Consumer and business confidence start to go down. When that happens, both businesses and consumers curtail their spending. So spending goes down. And when that happens, inventories start to build. So we get inventory levels starting to build, which then puts downward pressure on the price level. Now, just to let you know, we don't always get deflation during these times of contraction. Sometimes it's just disinflation, a positive inflation rate coming down. But generally, we're getting the price level to either go down or we're getting disinflation during these time periods. And also, we will eventually get some cuts in production because of these, oops, forgot the arrow right there, because of those higher inventories. Again, less spending, higher inventories, price level comes down, that's going to lead to less production. The less production is going to lead to some layoffs, right? So employment is going to go down. And then it is very important to understand that this gets reported in the news. How does that get reported in the news? As a decrease in GDP, right? And this gets reported in the news as an increase in the unemployment rate. So these two big economic statistics that get reported, they get read by people, and of course that feeds in to consumer and business confidence going down. And so you can see you get caught in these cycles. We generally think both businesses and consumers can get caught in these cycles. What we like to say, private sector actors who act in their own self-interest, get caught in these cycles, and we generally think they will not act in a way to counter that, okay? They are pro-cyclical actors, and what that means is they just go with the cycle. They just go with the cycle. And so that's a problem, because when you get caught in this particular cycle, which is a bust cycle, understand I could reverse all the arrows and have a boom cycle. That would be during the recovery or expansion. But I'm in a bust cycle, the recession or contraction time, okay? Here's what the arrows look like. We need or desire or want something to come in and to try to reverse this, right? And that's where monetary and fiscal policy comes in, okay? Fiscal policy, a management of the government's budget, okay? A management of the government's budget. What do we mean by that? Well, at a big picture level, guys, we're managing the inflows into the budget, mainly taxes, and the outflows out of the budget, what we generally call government spending, or sometimes break into government purchases and transfer payments. So again, we're managing the taxes, the inflows, and the outflows out of the government purchases and transfer payments, okay? So that's what fiscal policy is. It's a managing of the government's budget, generally to stabilize the economy, the business cycle. Now, fiscal policy is kind of interesting because it can focus on another goal of macroeconomics, which is economic growth. So there's mainly two goals of macroeconomics. One, stabilize the business cycle, which I like to say is kind of like the biggest goal of macroeconomics, but there is another goal called economic growth, or focusing on economic growth. And fiscal policy can focus on growth, but generally when we think of fiscal policy in a macroeconomics class, we're focusing on its demand management. What do I mean by demand management? It's management of demand for goods and services, not really focusing on its supply side policies that fiscal policy can follow, okay? Mainly in a macroeconomics class, we're focusing on its focus on spending. And that's it right there. I want you to see right there, that jumping out at you, because this is the main focal point of fiscal policy. So what will we do with fiscal policy when we're in these down periods? Well, taxes, we will lower them. Why will we lower them? To increase disposable income of households so that households will spend more, trying to get that arrow to reverse. On the outflow side, we might increase transfer payments. Think of a stimulus check, okay? So increase transfer payments, maybe do some stimulus checks. Again, increasing disposable income to get households to spend more. Or we might just do some government purchases. We might just start building roads and bridges and other infrastructure projects. So the government could spend itself to, again, reverse that arrow. And the idea is, if we can get that arrow to turn back up, all the other arrows go along with it. So when you're in that period of recession, of contraction, you're trying to work counter-cyclically to moderate it, counter-cyclically, trying to counter this so that you can moderate, so you don't have that such a deep recession, okay? Now, let's talk about monetary policy. Now, monetary policy is managing to the best it can interest rates in the economy. Now, it does not control interest rates, but it has a lot of influence over interest rates. It has a lot of influence over short-term interest rates, and through its influence over short-term interest rates, it can affect longer-term interest rates. So it can affect generally interest rates in our economy. Why do we call it monetary policy? Because the interest rate is the price of money, right? It's the price of money. If you lend money, you're going to earn interest determined by the interest rate. If you borrow money, you're going to have to pay interest determined by the interest rate. So the interest rate is the price of money. So that's what we want to think of. Oh, monetary policy. Oh, that's managing the price of money, the interest rates in the economy. So what will monetary policy authorities, the central bank of a country, which would be the Fed in the United States, we call that the Fed in the United States, so the U.S. central bank is the Fed. So what will our monetary authorities, again, central bankers, do during these recessions or contractions, okay? They will lower interest rates in the economy as best they can. They have a rates, some administered rates that they control directly, and those administered rates affect short-term rates, and again, the short-term rates should affect longer-term rates. So they have a way to manage these interest rates as best they can, influencing them either up or down. So again, if we're in a recession or contraction, they're going to try to get interest rates in the economy to go down. Why get those interest rates to go down? Two reasons. People will save less because the benefits of savings is going down. And if I save less, well, what am I going to do? I'm going to do the opposite of saving, which is spending. So I will spend more. Or we're trying to get people to borrow more because we're making it cheaper to borrow. And why do people borrow or businesses borrow? Again, to spend. And so you're getting something that's very important here, guys. Both monetary and fiscal policy, generally speaking, focus on spending. They are called, again, demand management policies. They're trying to manage the demand for goods and services. They're trying to increase the demand for goods and services. When you increase the demand for goods and services, you are getting more spending in the economy. Again, back to fiscal policy. Lower the taxes, increase disposable income to get more demand for goods and services. Give them stimulus checks, right? Give them stimulus checks so that their disposable income will go up and they will demand more goods and services, spend more on goods and services. Or the government itself could demand more goods and services through spending directly itself. And then again, back to monetary policy, central bankers, right? They're going to lower the interest rates to get what? People to save less and therefore demand more goods and services, spend more money, or borrow more, right? They're also very much focused on business and consumer borrowing. And so they're going to try to get businesses and consumers to both borrow more and demand more goods and services, spend more money. The big thing I want students to always do is link the term demand or aggregate demand, okay, total demand for goods and services in the economy with kind of total spending. They're doing demand management. They're managing our demand for goods and services, our spending on goods and services. That's what monetary and fiscal policy is doing. Now, just as we end this video, right, these times of recoveries, they can be prolonged also, and they can turn into quite big booms, okay? And like I said earlier, the bigger the boom, the bigger the bust. So they're gonna wanna moderate those also. Again, when we get into these periods, all these arrows are opposite. All of these arrows are opposite. Consumer confidence goes up, they spend more, inventories go down, price level goes up, we could have inflation as an issue, production goes up, and employment goes up, which feeds back into consumer and business confidence going up, and we get in these prolonged periods, again, they can act counter-cyclically. Who is they? The government, which controls fiscal policy, and the central bankers, which controls monetary policy. They can, the central bankers will raise interest rate, government through fiscal policy would raise taxes, cut back on transfer payments, and maybe cut back on spending to manage those boom times. Monetary and fiscal policy, those are macroeconomic policies focused on demand management, focused on spending in the economy. Why do we use them? Because we grow in this cyclical pattern and we want to moderate this cyclical pattern. I hope that made sense to you. We'll see you in the next video.